So the loanable funds market has the demand and supply, right? The supply side is the savings and the demand side is businesses. So this curve together, right? These supply and demand together will determine the price, which is the interest rate. So this price is just like what I said before, just like any other market determined price is determined by the interaction of the supply and demand. So at an equilibrium, the interest rate becomes 5% and the quantity demanded for investment is $250 billion and a quantity supply of the loanable funds will be $250 as well at the interest rate of 5%. So now let's take a look at the whole idea, right? So the good is the fund, the price is interest rate, and the supply side, which is the savers, and the demand side, which is the borrowers. Okay, so now if you have positive balance in either a savings or the checking account, you are a supplier in the loanable funds market. So basically for savers, the interest rate is a reward. So every dollar saved today returns more in the future when the interest rate is positive. So the higher, right? So the higher the interest rate, the greater the return in the future, and the more people want to save, which is going to be an increasing, the increase in the quantity of loanable funds supplied. Okay, so the price you receive now is going to be in percentage, right, instead of like dollars, but you can calculate this. For example, if the interest rate is 3% per year and you put $500 in the bank and you earn the 3% annually, right? So $500 for 1 year, the interest rate is $15. So, right? So your savings $500 will pay the $15 for the year. So loanable funds then follow the law of supply, right? The quantity of savings rises when the interest rate increases. The higher the interest rate, the greater the returns and the greater the quantity of loanable funds supplied. Okay, all right, next. Again, if you have a saving account, the thing that incentivizes you to save will be, the interest rate. If the interest rate is really low, you might not see any differences between saving and spending. All right, so this table represents the future value of $500 in savings at different interest rates. Like I said, the higher the interest rate, right, it tends to be, you can have high return is a reward for saving. Okay, 6%, 10%, you get more. Now, let's take a look. This is a law of supply, right? The higher the price, the greater the quantity supply, because the value of the return that you get after 1 year will be higher. So I want you to try this, okay, and see whether this is a really good investment or not. Okay, so the class activity, we are going to do this together when we get to come to the virtual class meeting. In the virtual class meeting, we will do this one together. Okay, now the practice what you know is the same thing. I will be doing this during the virtual class meeting. All right, so let's get to the interest rate as a cost of borrowing, right? So it was a reward for the savers, but it's the cost to the borrower. So high interest rates mean a firm pays more to borrow, right? So the interest rate is the cost of borrowing. So that means firms should borrow only if they expect a greater return on their investment than the loan cost, right? When should a firm borrow? Only if the return is larger than the cost. Okay, so what they would do a cost benefit analysis, and they only borrow if expected return on investment is larger than the interest rate on the loan. Okay, and then we do the practice what you know later. All right, so savers and borrowers care about the real rate of interest on the loan, even though I just told you a moment ago that on the graph we're only plotting the nominal interest rate, but we actually care about the real interest rate. What is the real interest rate? This is the interest rate that corrected for inflation. Okay, but the nominal interest rate is just the rate that we hear all the time in the news and things like that. We can only specify, the nominal interest rate before corrected for inflation. So I am going to ask you to write this down because this is really important. It's called the Fisher equation. This equation relates the inflation to the real and the nominal interest rate. So the original Fisher equation said the real interest rate is the nominal interest rate minus the inflation rate, or we can rewrite it in a different way that the nominal interest rate is the real interest rate plus the inflation rate. So what does it mean? It means the higher the inflation rate, the greater the nominal interest rate. Okay? The higher the inflation rate, the greater the nominal interest rate. Right? It could be the relationship right there. So can the real interest rate be a negative value? Definitely. Okay, if the nominal interest rate is so low, but the inflation rate is really high, then the real interest rate could be a negative value. Okay, so the real interest rate described the real purchasing power of the funds. And we're going to take a look at the next slide, which show you the interest rates over time. So the difference between the real and nominal interest rate is, remember, the rate of inflation. Okay, the rate of inflation. The nominal interest rate is the stated interest rate on the loan, but the real interest rate got to correct for inflation. So again, higher inflation rate will lead to higher nominal interest rate, right? Even when the real interest rate are constant. And okay, so for example, we're going to take a look at the next slide here, please. If the inflation is positive, just like right here, the nominal interest rate will be greater. Okay, the nominal interest rate will be greater than the real interest rate. If the inflation is negative, meaning we have deflation, then the real interest rate right here, the real interest rate will be larger or greater than the nominal interest rate. So if inflation is positive but falling, we call this inflation, the nominal interest rate will be greater, but the gap between the two getting closer to one another. So this one is really big inflation and increasing rate of inflation. But if the inflation is getting smaller in terms of, the value, the percentage, then the gap will be closer, like smaller gap between the two types of interest rate. So again, the difference between the real and the nominal interest rate is the rate of inflation. Now, take a look at during this time in the 70s. So in the 70s, it is clear that the nominal interest rate are historically high when the inflation is also pretty high during that time. All right, now, quick summary. Here, what you should know so far, right? The supply loanable fund comes from people saving money. Interest rate is a reward for saving. Demand of loanable funds comes from people wanting to borrow money. So the interest rate is the cost of borrowing. So it's a quick summary. All right, we answered the first question, big question, right? What is the loanable funds? We have demand and supply, how the interest rate is determined. Now we're going to move to the second question. What factors shift the supply of loanable funds? Supply is savers, right? So there are two types of changes. If there's a change in the interest rate itself, it will be a movement along the supply curve of loanable funds. There's no shift in the supply, right? It's just moving along the curve. The shift in the supply of loanable funds is caused by three things: changes in income and wealth, changes in time preferences, and consumption smoothing. So I'm going to spend a few minutes going over the three different factors that will affect the supply of loanable funds. Okay, the first one, changes in income and wealth. Think of it this way. If we have more income, we save more, right? Or when we have a very low income, we save less. So the supply at any given interest rate will shift to the right if we have a greater income and wealth. Now, I want to extend this a little further to think about the foreign savings. So imagine the supply of savings or supply of loanable funds is just domestic citizen, right, in the United States. And then if other countries citizens, they have better economy, increasing the GDP, they save more, right, and they have a big savings. And United States market or economy is always a really safe, high return place to invest. So those foreigners' savings will be moved to invest in the stock markets in the United States, the bond markets in the United States, right? And maybe even deposited in the banks in the United States. So there are more funds that are coming from other countries that come into this loanable funds market in the United States, right? So again, because of an increase in the income and wealth of other countries as well, that could increase the supplies of loanable funds. And when the supply of loanable funds increases, it will shift to the right. The second factor is time preferences. When we talk about time preferences, it means, are you being patient? If you are being patient, so that means the greater the patience you have, you can wait. Okay? But generally, people prefer goods sooner rather than later, right? And funds is just a good, right? So basically, with a very strong time preferences, it means you're very less patient and you would like to get the money sooner. Okay, so that means weak time preferences, then they can save a little more. So what does it mean to us? Okay, it means something like the longer the loan period, right, the higher the payment that you're gonna get. But can you wait? If the people prefer now to later, then you would not see a lot of savings. So if the pattern of savings in the United States has changed and people started to have a strong time preference, then you would not see a lot of savings. That makes sense, right? So if you make someone wait later, you might have to compensate by giving them more interest, right? So that means it's going to be hard to get more savings. That makes sense? All right. So again, let me summarize this on the next slide. The time preferences are not uniform across individuals and the societies. So less patient people prefer now, okay, to later, and will save less. And time preferences help determine the savings rate. So when we look back for United States in the 80s and the 90s, we actually started to have lower savings rate, and people actually kind of blamed that the younger generation, like have lower time preferences, they have very weak time preferences, so they want to spend now and do not want to save and things like that. Okay, so again, the time preferences help determine the savings rate in the United States, in the society. The savings rate is calculated as personal saving as a portion of disposable income. Disposable income means income after paying taxes, right? So abrupt changes in the overall savings rate are rare but not unprecedented. So now, actually, economists study this and they look at it and say, well, maybe it's not about time preferences that we have weaker and weaker time preferences in the United States that contributing to lower savings rate. It could be something else such as we have different ways of savings. Instead of putting money in the savings account or stock market or bonds market, we might just put the money into buying other assets such as houses, right? We could invest in property, right? And that is the way to save for many Americans. So we would not see the saving rate as the proportion of the portion of disposable income because we put that into buying a house. Okay, so that could be contributing to a lower savings rate in the United States. All right, I'm going to stop right there. The slide for the time preferences here, right? For example, I just want to illustrate a point. You are attending college, right? So are you deciding to attend college? It depends on the options you have, right? Option 1, get a job, earn income immediately and consume now. That indicating that you have very weak time preference. But if you go to college, meaning you forego the current income and current consumption, right? And hopefully you have a higher future income and future consumption. So you decided to go to college. That implied that you have very weak time preferences. Okay, weak time preferences. Again, I'm going to skip the practice what you know, and we'll do this during the virtual meeting. Okay, so we're going to stop right there and we'll continue on the next